Good morning, everyone, for this session on discussing the settlement asset on-chain. As you can see on the screen, there is two possible options that we can consider. The first one is the stablecoin approach, which is relatively well known and we are not going to develop today, which is relatively easy to implement given that there is plenty of example of that on the net. It's also relatively easy to integrate with the DVP given the nature of its implementation, being very close to the ERC20. However, financially speaking, in order to be viable, it has to require the conservation of the deposit that forms the stablecoin as collateral, which means that the cash that is deposited by the user cannot be used for other purpose. And also it's not fungible with other bank or fungible between other issued stablecoin by banks, and therefore it has to centralize the issuance to single issuer. A good example of that you can consider using in your experimentation is convertible from Société Générale 4. On the other side, we have an alternative proposition that we'd like to share, which is considering normal cash account. However, considering that the IT system that is holding these cash accounts is the blockchain. So we are not creating something on the blockchain and trying to give it a legal framework. We are trying to say we have a legal framework for cash account and we use it on deploying it on a new type of IT system, which is the blockchain. So it's a little bit more difficult to get right, and we are going in this session to try to dig into what it means. And there will be another session on the more technical side of it. But the good thing is that given that it's a normal cash account on a commercial bank money, it enables the banks to use those deposits for their funding activity and therefore use it also to finance their other clients. So this is managed through the regulation, the capital and liquidity ratio that enables the bank to use the deposit of their client, obviously subject to satisfaction on the liquidity ratios and capital requirements. And this type of solution makes it possible to expose, in fact, the bank account as a smart contract and therefore connect within the same blockchain several banks accounts and make them transfer money to each other. We'll see how that works. So an implementation of that, which is currently on a prototype version, is SoCash, the Sustainable and Open Cash methodology. So let's try to go through an high-level reminder of what is commercial bank money versus the other type of money that is the central bank money. So this diagram is a very simplistic representation, but just to set things clear, you have on the right side the central bank. The central bank is issuing two types of money: the physical money, the coin and the note, and the money that are used by banks. So commercial bank have an account with the central bank. So those two types of money are what we call central bank money. I'm not talking here about CBDC or anything like that. I'm just talking about the fact that it is a claim on the central bank. If the central bank is claimed to be repaying that amount, they have to do so with the legal money in circulation. Now, if we look at the dark green area, it's the money that are emitted by the commercial bank. So there is the retail commercial bank money that are normal bank account that any individual can get. So an individual can obviously get coins and notes that are directly claimed on the central bank, but also bank account where they can get their money with a commercial bank. But obviously, as you increase the size of the companies through small and medium enterprise or corporate, you have to provide another type of bank money, which is more wholesale, because you're doing big transfer, generally speaking. And this is where we are going to focus in our discussion, because obviously here we are considering DVP and settlement asset for securities, so it's more large chunk of money. And let's not discuss about e-money, because these are different type of institutions. All right, so let's go to describing this relatively complex slide. What we want to display here is the following. On the upper part of the diagram, you can see the normal mechanism by which a bank, so CACIB in that situation, is managing its bank account. So they have internal back office system, which is generating various type of reporting, general ledger feeding and risk feeding. And when this back office system holding bank account is required to either receive money or send money to third parties, other bank, then it will use its Swift gateway in order to submit a message to Swift or to receive a Swift message. And this is how it's integrated with the back office system that is internally deployed. So let's remind ourselves how the Swift message are operated. When a payer, so a client of CACIB, for instance, want to submit, to make a payment to a beneficiary, first of all, there is a commercial relationship between the payer and the bank, because it has opened an account, indeed, and the payer, if it is a company that has Swift access, will request the bank to make a payment on its behalf by sending a Swift message. Then the bank will identify the correspondent bank of the beneficiary, so the bank of the beneficiary, and submit an MT202 Swift message that will instruct the beneficiary's bank to credit the beneficiary, but at the same time instruct the central bank to credit the beneficiary's bank with the money of CACIB. And this is the way the beneficiary's bank with this 202 message can be sure that it will be paid, and therefore it can credit the beneficiary's bank account. So that's worked well. It has been working for so many years. And it's relatively efficient so long that we know the correspondent bank and so long that we do not do cross-border payment. However, this is a very isolated mechanism because it works on Swift and it's a message-based mechanism, as well as the fact that the infrastructure are dedicated for payments, typically. So on the bottom side of this representation, what we try to address is another way of representing those bank accounts by saying that we could use, and we can use actually, the blockchain as an IT system for hosting the back office system of the cash. So CACIB back office will have an IT system for holding the cash account in two parts. One part will be sitting on the blockchain infrastructure, and with a part that is the connection part, which is the infrastructure that is sitting in the environment of CACIB that will enable integration with the rest of its IT system. So the interesting thing now is that within the blockchain, you can have direct communication, direct connection between smart contracts of the other banks, as long, obviously, as these other banks are implementing the same type of interface, hence the need of a standard. So the way the process will be working when the client of CACIB wants to make a payment, this client can directly make that instruction by making a call to a smart contract on the blockchain and in fact interfacing directly with the IT system of Casib sitting on the blockchain. And then the bank can monitor what's going on, but if it doesn't have to intervene, then the blockchain can directly make the instruction to the beneficiary's bank in order to credit the beneficiary. Then we have a situation where Casib has a debt to the beneficiary's bank. And in that circumstance, we have to find a way to credit the beneficiary's bank after the transfer to the beneficiary account has been done. And this is done by interfacing the blockchain with the central bank clearing system. And we are going to see in the technical setup how this can be done. Let's now take an illustration of what such a mechanism can be by looking at the settlement of a bond against cash within a blockchain. So well, it's a very simplistic diagram, but it's trying to give an idea on what can be the mechanism, and we are going in following video to look into more detailed technicalities of that. So let's imagine that we have Casib in the dealing room agreeing on a transaction with an investor to buy X quantity of a bond from the investor. The investor is managed by Bank B, which is its custodian, and has a cash account on chain with its custodian. Casib, its back office, has also a Casib Cash module on chain. Now, the back office, when settling the transaction, will initiate a DDP, which is a smart contract, that will be linked on one side with the bond register and on the other side with the cash account of the beneficiary. Well, in fact, it's not linked yet at that stage. So the DDP is going to be notified to the custodian, and the custodian will countersign the deal and instruct which cash account should be debited in that operation. Because the custodian has accepted the transaction, it triggers the transfer of the securities to the custodian and at the same time transfer the cash from its client to the account of Casib. So in that case, we can have the cash module of Bank B, of the custodian, to trigger a transfer of cash to the cash module of Casib directly within the blockchain. And this is where the actual cash transfer happens within the same blockchain transaction. So that's an illustration, obviously. So we are going to terminate the video on this, and in the next video we are going to dig into how that can be implemented with the Sobong framework. Thank you very much.